A couple of weeks ago, we looked at the equity risk premium, discussing what has been driving the risk premium and where it was likely to move going forward. This week, our focus turns to global real yields. What has been driving them lower over the past decade or so, and where they might be headed over the forecast horizon. Clearly, it's an important issue because they have the level of real yields has implications for asset class valuations, obviously asset class returns, and also monetary policy setting. So we've drawn on recent analysis coming from the Bank of England and a paper out at the end of last year titled Secular Drivers of the Global Real Interest Rate. And where I want to kick off the discussion is just looking at a G3 measure for real yields. So US, Germany, and Japan we're using here, and we can see how real yields have been falling fairly consistently over the past 20, 25 years from levels slightly above 4% or 4.5% down through to around about 2% around the time of the GFC, and subsequent to the GFC have fallen to close enough to zero. So it's been a fairly consistent, steady decline, although the most recent downturn has been quite sharp. So we're going to investigate what have been the drivers of this downturn in real yields. The first point to make is to relate the level of real yields, as people mostly do, relative to growth rates in the global economy. So what we've got here is the same line. The blue line is the G3 real 10-year yield, and then we have the gold line, which is advanced economy GDP growth, and the green line, light green line, is world GDP growth. So what we see is that broadly they've tended to follow the contours of what's happening in the global economy, although the relationship sort of broke down in around about 2003. So real yields had declined to about 2%, yet they failed to follow the recovery and growth in the 2002 2006 period, and then of course fell away quite substantially in the post-GFC period. So changes in real growth may have some influence on real yields, but don't explain the whole story. Another way of looking at this, and this is often discussed as a key driver of real yields, is what the potential rate of growth is. And I'm using US data in this example only because we have data going back quite a while. And to build up some idea as to what potential growth might be, we often use labour force growth, and that's, in this case, that's the red bars, and then we also use productivity. And what I've done is just sort of taken a 10-year trend rate of growth for either of those. So if they're the components of what your potential growth rate are, then what it would suggest is that potential GDP growth in the 1980s through to about 2004 was probably on average around about 3.5, maybe just below. But what you see in the period post, say 2005, 2006, it's fallen away quite dramatically. Both labour force growth has slowed considerably, and productivity, as we know, has also slowed quite significantly. So it's suggesting that potential growth, real GDP growth, is somewhere closer to somewhere around about 1.5, maybe slightly above that, but certainly has come down a long way over the past 10 years in particular. Now, if we map on top of that what has happened to the real yield, that's now in gold. And just tracking this through, as we look through the period of the mid-80s through to about 1999, generally real yields were slightly above what we would have estimated to be potential GDP growth, and it's not unusual. What happened around about 2000 is that although potential growth rates were arguably, in fact, rising during this period, real yields went in the other direction and actually went below potential growth rates, as you can see here, from about 2000 through to around about the GFC. Then in this, so there's what we don't really know is what the explanation is here. There was something other than potential growth rates which were driving the decline in real yields. Then, of course, in the post-GFC period, we've seen real yields fall once again, still well below that of potential growth rates. The Bank of England paper then breaks out the causes or potential causes of the decline in real interest rates to growth drivers and also drivers in relation to investment and savings or desired investment and savings. But just turning first to some of the growth drivers, and of course one that gets talked about a lot and we've already alluded to is lower labour force growth. Now, um, the red line here represents an estimate of US labour force growth, annualised 5-year growth rates going back to the 1970s. You can see it's been on a bit of a downtrend, but particularly since the GFC. Now, this is not only structural, but also includes a cyclical element as workers left the labour force, participation rates fell. So it exaggerates the decline in sort of structural labour force growth. Perhaps a closer measurement is to look at working age population of the high income countries, which has fallen from about 0.75% per annum to around about 0.25. And in fact, the Bank of England suggests that lower labour force growth will cut growth by about 0.5% per annum by 2030, and that investment markets or real rates are already partly reflecting this, but it is in fact a fairly recent phenomenon. It has been very much post or around about the time of the GFC. The other growth driver, of course, that the Bank of England paper refers to is a slowdown in the pace of innovation, and that is estimated to have cut growth by about 0.5% as well as we reach what they term an educational plateau, which results or less gains from human capital accumulation, which results in lower productivity, lower incomes and increased savings. So they suggest that this also contributes to lower real rates. So decline in labour force growth and decline in the rate of or the pace of innovation are seen as fairly significant drivers, and they believe that it's responsible for about 100 basis points in total of the decline, largely post the GFC though in real yields. Perhaps the more interesting area or of the decline in real yields um, has been in changes in the desired level of investment and savings, as discussed in the paper we've been referring to. So we just saw that growth alone can't describe the decline in real yields over time. And in fact, most of the decline related to growth has occurred in the post-GFC period. As we saw at the outset, real yields were already falling from about 2000 in particular to 2006 and indeed before that period. So we use what we in economics talk about the investment and saving schedule. By definition, actual investment should roughly equal actual savings. But what we're looking at is the relationship between desired savings and desired investment. So as one might expect, the relationship runs along the lines of higher real rates, desired savings tend to be higher, and desired investment tends to be lower. So if we start off with a curve, and we can see here the blue line is a saving schedule. So for each level of interest rates, which is given down the bottom here, each level of interest rates, 6% there, we have a higher level of desired savings and a lower level of desired investment, and so on and so forth as the real rate changes over time. So the way it's described is one of the first shifts, and we'll look at the savings schedule first, is demographic change. So when you get a decline in the dependency ratio or an increase in the working age population, which you did see during the past 25 to 30 years, they tend to be the highest savers. So a reduction in dependency ratio or an increase in the working age group leads to a higher savings rate. So what that effectively does is shift the savings schedule to the right. It goes from the blue line to the green line. You can see that it shifted across savings schedule 2, and then that alone would tend to have a dampening effect on real rates. So if equilibrium real rate would go from around about 4%, for example, down to the new equilibrium, which might be closer to 3%. And indeed, the Bank of England suggests that this demographic effect would have had about a 90 basis point reduction in real yields over time. Now, what we should also consider, and they consider, is rising inequality. And the thinking there is that with the rising inequality over the past couple of decades, the wealthy tend to save more. So this also leads to an increased level of savings for each level of interest rate. So if we now introduce savings schedule 3, and that pushes it once again to the right hand side, you can see here a new equilibrium on the real interest rate will now move down to, let's say, 2.5%. So it is declining as we push the savings schedule to the right, i.e. high level of savings for each level of interest rate. They also talk about the emerging market savings glut, and that is introduced by schedule number 4, and that it once again pushes it. So in the aftermath of the Asian crisis, the argument is that the central banks of Asia increased their FX reserves, and at the same time they had an increase in oil prices, which wasn't spent by the oil producers within Asia, leading to an increased level of savings. So that also contributed to a decline in real interest rates. Now, if that was the only movement or factor occurring during that period, you might have expected the actual level of savings to have increased. But in fact, what we find is that the savings and investment ratios of GDP globally have stayed pretty steady, really, over the past 30 to 35 years. As you can see here, data from the IMF shows in the red is the investment to GDP ratio for globally, and the blue is the savings to GDP ratio. So they've been pretty steady between 22 and 26, an average, let's say 24% over that time. So what that means is then, although desired savings was increasing, actual savings has been fairly steady, and it can only have occurred if there was something else going on, for example, to the investment schedule, which we'll now turn our attention to. So the first movement in the investment schedule, that's the red line there. So that's where we started. So we're currently at this equilibrium point, if you like, interest rates down around about 2.5. The Bank of England paper talks about the decline in the relative price of capital goods over the past 30 years. So if we just look at one particular measure of capital goods prices, and I'm using import prices in the US of capital goods, we can see that that index has fallen from here in 1996 down here. That's about a 30% decline, more than a 30% decline in import prices of capital goods. So it gives you some sort of indication as to the deflation that has occurred at the capital goods level. So the what that does is it reduces the cost of investment projects. So therefore, there's less nominal investment at each level of interest rate. And so what we would do in that instance then is introduce investment schedule 2. That's the green line now. So that's pushing the investment schedule down lower, and the effect is to once again is to lower the interest rate. It would move from this point here to about here. So the Bank of England suggests that that's accounted for about a 50 basis point decline in real yields over that period. They also talk about public investment being a small effect, a decline in public investment over the period in question. What I want to look at next is the second last area is the increase in the spread. So while the risk-free rate has declined quite a bit, the spread has actually increased. So the return on capital, the rate of return on capital or implied discount rate has not declined by nearly as much, and in fact, that spread has actually increased. So what that then means is that also will tend to shift the curve, as we can see here. I'll introduce curve investment schedule 3. So that's another shift in the curve down. So the intersection now between schedule 3 on investment and schedule 4 on savings is out here, leads to another decline in the real or the equilibrium real interest rate, and the Bank of England estimate that to be around about 70 basis points. So that is quite a significant move. So when we add the reduced cost of capital, the decline in public investment, and also the increased spread and the impact that has, we get to about an extra 150 basis points of decline in real yields by the investment schedule moving over. And then finally, if we add back in the growth impact that we talked about at the outset, then I'll just introduce that one here. That's investment schedule 4. So the new equilibrium, if you like, is pushed out here. Real yields down around 1%. We know they're actually slightly below, but these are stylized charts just to sort of run through each of the arguments. So there's a number of factors that the paper talks about as being reasons for the decline in real yields over the past 30 years, but it also breaks it up pre-GFC and post-GFC, and there are different factors at play. Some of these will unwind partially, some of them will be maintained. Their view is that real yields are likely to stay low, although there might be a modest increase, but essentially they're looking at real yields staying low in the period ahead. Thank you.